blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
What's up, Abe Nation? Boss Blunts. Got a live stream going here. Let me share it out a little bit. Wow, that was fast. What's up, everybody? How did you guys get in here so fast? Boss Blunts, Marcel Klunevic coming at you one more time. Got this fucking report. I couldn't just let this go. This thing just came out. So I had to pull it up. I couldn't just let it go. It was too much. These banks are doing some crazy shit. I gotta check it out. I gotta see it. Look at these losses.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2.
Bank of New York Mellon is climbing. HSBC is climbing. Gee, could it be because of Evergrande Bank? I don't know. They were doing all right until recently. Wow, up until about 3 to 6 months ago. And it's been a steady downward trend. What's up, everybody? Caden, Peter, D-Wade, Dank, Kershaw. It's nice to see all you guys and girls. Thanks so much for coming out. I hope you dig the Cowboy Bebop theme. I love anime, and Cowboy Bebop always has. Let me tweet this out there, man. Nobody knows I'm doing this shit. It's the middle of the night. Let me just get it out real quick and then we'll start it. Yeah, alright. Got some pretty graphs to look at and shit like that. Somebody asked me for the losses and then I went to go look at it. And then, holy shit, look at all these precious metals. Holy shit. They're gouging us. Put it in precious metals. Isn't that interesting?
You're an original, aren't you?
Cowboy.
I think it's time to
Yeah, let's take a shot, man. Cheers.
Okay, 3, 2, 1, let's go.
Emilio says he already picked out the color for his Lambo. That's cool. Popping out there on Twitter. You know how it goes. Damn algorithms. And I'm shadow banned too on YouTube. People are gonna updates. Put it out there. Had a fire one earlier. A long video about economics, Evergrande, future cycles.
Oh, great. You're an original, aren't you?
Cowboy.
I'm gonna save that one here for a little while. Then I'll give you guys more details on that. Look at this.
Bang.
Second quarter trading revenue was 22.9% less.
Oh, great.
Wow. Woo-wee. Wow.
The bounty cutter. Bang.
What's up, Abe Nation? Give me a minute. I'm working on it. Got so much due diligence over here. It's all in the way. All right. Tabs on Windows.
The bounty cutter.
Ooh, we get stopped that right there before we get a little copyright infringement by Tank. Let's get that stopped right there. Tank, excellent crew. a band. They do that song for Cowboy Bebop, in case you're wondering what the hell I'm rambling about. Derivatives contracts, credit default swaps, mortgage-backed securities, CDOs, super senior synthetic collateralized debt obligations, futures contracts. All of these represent 73% almost of the total derivative notional amounts. Total derivative notional amounts means potential losses. Unrealized potential losses. Unrealized losses, not potential. That's what they're currently valued at. So, what's up, Edgar, Thunder, Harvey, Kevin, Foot, Test, everybody, Gia? It's good to see you. All right, sorry if I missed your comments, everybody. Trying to catch everybody's comments. My apologies if I missed anybody. This is a 2021 report. It was just released. It's a second quarter report. They just released it on September 16th. And I didn't even know it came out. I've been checking it every day, but I didn't on the 16th or 17th because I was so excited with AMC and GameStop, to be honest with you. But whatever, here it is. Check it out. Precious metals, all-time highs. We thought they were high in the first quarter of 2021. They were just getting started. I think they still are. Just getting started. We will see here what happens. Hang on one second. Wow. This is the quarterly trading revenue. Cash and derivative positions. This has decreased a little bit, probably because their cash positions are decreasing. And they're putting more of it in holding companies than ever. So, good morning, Martin from Norway. Pedro, what's up? Javi. Yeah, drop a like if you don't mind. Let me know where you're from. I want to see where Ape Nation's from. Because I need some places to visit after MOASS, that's for sure. All right, thanks a lot to my mods. Appreciate you guys. Let's take it from the top, guys, because this is a big-ass report. It's 48 pages. It's always 48 pages. For some reason, and we'll hit the key points. I haven't even read this one. I'll just go to the parts that I know are kind of important in these reports, because as soon as I saw it, I'm just gonna fucking live stream it. We need a video about this, so put it out there. This is the 103rd edition of the Office of the Comptroller of Currencies quarterly report on bank trading and derivatives activities. Yeah. So, Commercial Banks and Savings Association reported revenue of $8.1 billion. And that's $2.4 billion less. Yeah. And $5.6 billion less than the year earlier because of the artificial printing of federal government money and the fact that they're actually seeing much more losses than they were back then. Even though banks are making a ton of money, they're losing just as much, if not more, 10 times over. What's up, Texas? Robin from Texas. Danny from Sweden. Wow. David from the LBC. I love it. Gamma Ray from Texas. A few. That's great. Aaron from North Dakota. Corrupt Milwaukee. OG Ape in Chicago. That's what's up, OG. Got Missouri, Riverside. That's great, you guys. San Diego. Appreciate you. What's up, Kilman? Good to see you, buddy. What's up? Hey, it's At the Bull House. Make sure you guys check out the At the Bull House podcast and YouTube channel. They do a lot of information on stocks every single day. Fantastic if you ever need some plays for like post MOASS and Kenna over there and the other guys. They do a great job of hosting. They have awesome guests. And I think it was a week or two ago, Jackson Hunter and I did Takeover Tuesday over on the Bull House. That was a lot of fun. They're such a great, smart crew. And Kenna's got such great input. We did. She's the one that we did the video from. If you guys haven't seen it, we did a video with her just a couple days ago. Definitely very interesting about the fall of Rome and how the United States basically was looking exactly the same way as the Roman Empire did back then. So it's a wonderful due diligence, basically about the due diligence of everything. Credit exposure from derivatives has increased significantly. Exposure, they use something called a process called bilateral netting in order to, very nefarious process at that, in order to reduce their exposure. But their exposure has decreased in the second quarter compared to the first by $5 billion, about 1%. So that's how they reduced the number ever so slightly, but it doesn't really make a difference because they still owe $183 fucking trillion in derivatives liabilities. The notional amounts decreased by about 5.5 trillion or 2.9%, but the contracts still remain interest rate products, about almost 73% of the derivatives contracts. See, when you got something like this, you see like their quarterly bank trading revenue. They're significantly down across the board. All right, and then holding companies, they are also down across the board. They're losing so much money on short positions. Consolidated Bank Holding Company, a holding company, according to Oxford Dictionary, is a company which is created as a shell company, usually overseas, in order to hold assets and liabilities. The quarter-over-quarter decrease in trading revenue was due to decreases across all trading instruments except interest rate contracts. They're not putting their money in anything else except for shorting crap to keep themselves liquid and the RRP program. That's an interest rate contract. And if year-over-year holding company trading revenue decreased by $12 billion, 34%. So, what's up, everybody? Thanks for stopping in. Count Stonkula, good to see you guys. Jonathan. It's which company? It's all the companies. It's all the fucking banks, guys. It's not which. Look, the 2008 financial crisis really brought us down a notch. And that's kind of the way we're looking towards next here. And we'll show you why. The positive fair values. Positive fair values means, derivatives that have a value that is positive, right? Easy. That's down almost 19% for the gross positive fair value. That's pretty shitty. And at the same time, thankfully for them, at least their gross negative fair values are down a little bit, about 20%. So just barely there. And they do something called a netting agreement. Put it simply, it's a legally enforceable agreement that allows them to create a single legal obligation for all transactions. They'll take 100 of these derivatives, and this other bank will take 100 of these derivatives, and they'll trade them to each other. And they'll pretend like if they all cancel out, they'll only owe the difference between all these 200 derivatives. This is called bilateral netting. It is fucking fraud, and it is a scam, and it's not really working well in their favor anymore. But they're still using it. It's not working as well as it used to, I should say. Because as you see, the netting benefit is down almost 7%. The netting benefit percentage is down almost 1%. Okay? You don't have to understand exactly what it means to know that it's bad for them. Let me just put it this way. It's the primary metric that they use to evaluate credit risk in bank derivative activities. Okay? And when the benefit is down, that's not good. And the gross positive fair values are not good either. Net current credit exposure peaked at $804 billion at the end of 2008 during the financial crisis. The decline since 2008 has largely resulted from the declines in the gross positive fair value of interest rate and credit contracts. So they're saying things haven't gotten any better. The positive fair values have gotten worse. Increase in NCCE during the first quarter as markets respond to the financial impact of COVID-19. And as they ended during the second quarter of 2021, it was lower at $441 billion as more normal market activity. So they did reduce their credit exposure ever so slightly, but that doesn't mean that it's not at a ridiculously high level. Second highest only to the 2020 crash, really, and 2008. Goldman Sachs total risk-based capital. They have $39 million. No, this is $39 billion. Okay. And this is $269 billion because this is 269,803 millions, which is 269 billion, 38.7 billion. Bank of America, 184 billion. Citibank, 165 billion at risk. Capital requirement. You know what that means? How much money they need to keep on hand. Right? Okay. Their quarter-over-quarter change has increased. Their balance sheets are not getting better. J.P. Morgan Bank managed to, increase their ever so slightly, 143 million. What's that off of $269.8 billion? Nothing. Citibank got added 40 million more. So you see the way that that's expressed. So we'll just move on so you don't have to dwell on that. The VIX, beautiful. Figure 3 shows the VIX, which measures the expectation of a stock market volatility in the S&P 500, right? It exceeded its previous high from the 2008 financial crisis before reverting to a more normal level, in 08 after 2021. Here we go. It's at 15.8% as of this writing. Well, that was at 6:30. You guys know what the VIX looks like now? Because if you don't, I'll show you real quick. He's currently at 20.81 and rising. That's for sure. Level 3 trading assets. They don't have many assets. Sorry, hang on one second. They have less assets than they have in a long time. And more liabilities than they've had in a long time, to the tune of $184 trillion. Look at these amounts of derivatives. So they rolled 4.6%. They reduced their credit derivatives exposure by 4.6%, but increased their equity total return swaps by almost 20%. This is their credit derivatives. They decreased by 255 billion, 7.6%. Investment grade entities with maturities from 1 to 5 years. Why do they do that? Because they're not taking out as many long-term investments. They need to keep cash on hand. Compression activity. We'll skip that. You don't need to know that. Look at this. Is how much is going through lit exchanges. This is how much is not going through dark pools. Okay, so as you can see, very little of it is not going through dark pools. Futures contracts. Futures. Foreign exchange, fiat. Okay, fiat trading is almost less than 2% across the board traded in lit exchanges. It's all being hidden in dark pools. Equity total return swaps, almost 3/4 of it, 75% of it is being traded exclusively in dark pools by all of these banks combined. Almost the entirety of precious metals is being, almost 97% of it is traded in dark pools. Do you see what I'm fucking saying here? They're maintaining these prices at the levels that they want them. Here's the example of bilateral netting. It's a legally enforceable arrangement between the bank and the counterparty that creates a single legal obligation covering all included individual contracts. So in order for them to make these numbers look better, they're fucking trading 100 contracts here and 100 contracts there to each other and just pretending that they only have to pay the losses on one contract if they all cancel each other out. Shorts and longs. They're still fucked either way. They're just making it look good on their books. That's what bilateral netting means. And if you think I'm bullshitting, oh, let's just go straight to the fucking numbers. You don't like pretty graphs? Let me give you some numbers. JP Morgan Chase has $3.1 billion in assets and has $53 billion in unrealized fucking total derivatives notional losses. Goldman Sachs only has $350 billion, and they got $47.7 billion in unrealized total derivatives notional losses. Can you be more clear? This is how many futures contracts they have that they rolled over during the international money market dates, the IMM date that we talked about, 9/15/2021, 9/16, and 9/17. 9/15 was the last day. It was the last Wednesday of September, the third Wednesday of September. That is the one of two semi-annual dates that all futures contracts must be rolled, or some as late as their expiration on September 17th. The price action for the contracts rolled on September 17th is going to be seen on Monday, September 20th, September 21st as well, because these trade on T+1 and these credit derivative swaps, CDS, trade on T+2. That's a one settlement day it takes to show the fact that those trades have settled. So we will see that on Monday and Tuesday, September 20th and September 21st, 2021. Same with here. These total options right here. Goldman Sachs, $1.1 billion in total futures alone. They owe more in futures contracts than their entire fucking assets alone, not including the rest of their derivatives. Do you understand how bad these fucking numbers are for them? Citibank has $1.6 trillion $1.6 billion in assets, and they have $43.3 billion in unrealized total notional derivatives losses. Okay? And these futures contracts that these shills on Reddit are trying to pretend don't work and pretending to say that these future cycles aren't real, they absolutely fucking are real. They absolutely fucking are real. Okay? $2.3 billion that Bank of America has, but they owe $18.5 billion in total derivatives. That is why Bank of America filed to sell around $200 billion in assets last month. Okay? Wells Fargo has only $1.7 billion in assets, and they owe $10.2 billion in unrealized derivatives losses. Unrealized because at any point when the stock market tanks, these unrealized derivatives losses are going to increase exponentially. And then all of these companies and all of these banks and prime brokers they end up having to pay for these fucking short, over-leveraged hedge funds and banks. We're going to see a ridiculous amount of margin calls, and from those margin calls, eventually will come some margin defaults. Need I say more? State Street Bank. These assholes are going to merge with Paribas, BNP Paribas, because they cannot meet. State Street Bank is merging with PNC Paribas, whatever the fuck their name is, because they cannot meet the $1 trillion margin requirements that begin on October 1st, 2021. Plain and simple. If you can't meet the requirements because you only have $322 billion in assets, you have to merge with another fucking bank to meet the $1 trillion in assets. That's the reason they're doing it, out of sheer desperation to not get margin defaults on October 1st, 2021. That's it. That's it. I'm done. Fuck these banks. Cheers, Ape Nation. Love you guys. BNP Paribas. Thank you. Peace and wealth. Love you guys.